Germany's industrial production unexpectedly declined in November as manufacturing woes in Europe's largest economy continue.
Economists had predicted a 0.3% rise, but output fell 0.7% compared to October. This is the sixth consecutive monthly decline. GDP is also predicted to have contracted in the fourth quarter. Well, Germany's industrial weakness is having something of a ripple effect on countries linked to its car sector. In Hungary, the German motor industry generates 2.5% of the country's GDP. Hungary's industrial output fell 5.8% year-on-year in November, while in the Czech Republic there was a 2.7% decline. There are also concerns about the future of Germany's domestic car industry. Last month, the government dropped a state subsidy on electric vehicles, making it more costly for consumers to buy them and potentially putting the brakes on the country's EV market. And in November, a court ruling plunged the government's 2024 budget plans into chaos, leaving an $18 billion black hole in public finances. That's meant a rather bumpy road to the new year with a wave of strike action, including farmers' protests over plans to scrap tax breaks on diesel. Well, Marc Ostwald is chief economist and global strategist at the investment broker ADM ISI. Marc, good to see you. Well, I think, first of all, in your judgment, what is Germany's problem? What's going wrong?
Well, there's a combination of factors. One of the biggest drags on industrial production at the moment is construction output. That fell 2.9% again next month. The whole real estate sector, whether it's commercial or whether it's residential, is in deep trouble. But the weakness was broad-based. There were falls basically across the board. The smallest weakness, ironically, actually, is in capital goods, which is at least some sort of relief. But the auto sector is definitely a problem. It's not just a question of those subsidies, so from the government for EVs. It is broadly becoming, it's just not got the relevance or the models to compete with either China or with the US, particularly Tesla. And then there's the broad-based problem of the energy-intensive industries, things like petrochemicals, glass making. Even with the fall that we've seen in power and gas prices, they still are basically on a much reduced output level relative to where they were before the prices spiked. So most of them output is down about 20%. So the headwinds are substantial, and the fact that they've not really prepared for a changing environment in terms of industrial demand. What goods do people want in the energy transition is basically, it's a legacy problem from the Merkel government, to be very honest.
And Germany's weakness really is rippling into surrounding areas, isn't it? Into Central and Eastern European economies, linked in particular to the German car sector. Just how significant is this spillover?
It's very significant. Czech Republic, Slovakia and Hungary and Romania all suffer. You can see it also in the weakness in intermediate goods output. The demand, the demand for EVs in Germany isn't perhaps picking up as one might expect it to, but equally the demand for hydrocarbon cars, and so the spillover effect is very substantial. The real problem that it highlights is Germany already did a lot of outsourcing, and now it's having a spillover effect. And the fact that the end goods, which were finally completed in Germany, basically that production demand, which feeds out into Central and Eastern Europe, is simply not there anymore. Or put it this way, it is there, but it's there at a much reduced level. So there will be an impact. Other countries, probably like Poland, probably less vulnerable because they have their own industries and other areas which people are investing in. But the smaller countries, which are really dependent on the German demand, the German manufacturing demand, are going to suffer.
Neither Germany nor Europe can operate in isolation. I want to ask you about global economic factors and their contribution to this weak external demand for German exports, German products.
Yes, well, I mean, I think the key in this, Germany's dependence on China, and there's a mutuality there, which is part of the broader EU-China trade. Well, there are tensions there, but there is a dependency one on the other, and Germany will always suffer the most. You can see it, actually, if you distinguish Germany from Italy. Italy is not doing nearly as badly as Germany in terms of the manufacturing sector, because it hasn't quite got the same sort of dependency on Chinese demand. And the weakness in Chinese demand is well documented, as is the fact that China is moving more and more to producing a lot of the things at home which Germany previously exported to it. I would call it German complacency, basically, being caught out here.
Mark, good to see you. Thanks for that. Marc Ostwald, the chief economist and global strategist at the investment broker ADM ISI.